Hello, and welcome back to Financial Market Insights for Traders, the show where we cut through the noise, break down complex financial concepts, and give you the tools you need to navigate the markets with confidence. I'm your host, Sophia, and today's episode is packed with value because we're diving into two pillars of macroeconomics that affect every trader, investor, and saver out there. We're talking about the impact of inflation on savings and what GDP is and why it matters. Now, I know these might sound like topics from your old economics textbook, but trust me, they are far from academic abstractions. These two factors are deeply connected to your portfolio, your cost of living, your job security, and even how much your morning coffee costs. And yes, we're going deep. By the end of this episode, you'll have a practical understanding of these concepts, and you'll know how to use them to make smarter decisions in your own financial life. Part 1: The impact of inflation on savings. So let's start with inflation. You've probably heard the definition before. Inflation is the rate at which the general price level of goods and services rises over time. Usually, it's expressed as an annual percentage. Sounds harmless enough, right? But here's the kicker. Inflation is a silent tax on your savings. Let me give you a concrete example. Let's say you have $50,000 sitting in a savings account. Your bank gives you 2% annual interest. That means after 1 year, you've got $51,000. Feels good until you check the inflation rate. If inflation is running at 6%, that means you would need $53,000 just to maintain the same purchasing power you had at the start of the year. In reality, you've lost $2,000 in real terms, even though your bank balance has gone up. That's the brutal truth. Inflation eats away at money that just sits in a low-yield account. Different types of inflation. Not all inflation is created equal. Economists often categorize it into three main types. Creeping inflation. This is the healthy kind, running at around 1 to 3% per year. It encourages spending and investment rather than hoarding cash. Galloping inflation, double-digit inflation, 10% or more per year, which starts to erode savings at an alarming rate. Hyperinflation, we're talking about 50% per month or more. Thankfully rare, but it's financially devastating when it happens. Think Zimbabwe in the late 2000s or Venezuela more recently. How to protect your savings from inflation? There are a few key strategies. Invest in growth assets, stocks, real estate, and certain commodities have historically outpaced inflation over the long run. Consider inflation-linked bonds, for example, Treasury inflation-protected securities, or TIPS in the U.S. Adjust their value based on inflation rates. Diversify globally. If your country's inflation is high, holding assets denominated in stronger currencies can offset losses. Avoid idle cash holdings. Keep just enough for emergencies. The rest should be working for you. Reinvest your earnings. Compounding growth is your ally, but you need a return consistently above inflation. The psychological side of inflation. Inflation doesn't just affect your bank balance, it changes how people behave. When prices rise quickly, people often rush to buy before costs climb higher, which can actually fuel even more inflation. Savers may feel pressured to take on higher investment risks without proper planning. And retirees on fixed incomes feel the pinch hardest. Their purchasing power declines steadily, even if their nominal income stays the same. That's why, as traders and investors, we have to look beyond the numbers and understand the human reactions inflation triggers. Part 2: What is GDP and why it matters? Now, let's shift gears to GDP, Gross Domestic Product. This is one of the most important indicators of an economy's health. It's the total value of all goods and services produced within a country's borders over a given period. Think of it as the economy scorecard. Types of GDP. There's more than one way to measure GDP. Nominal GDP. This is the raw number, measured in current prices. It doesn't account for inflation. Real GDP, adjusted for inflation, which makes it much better for tracking true economic growth. GDP per capita. GDP divided by the population, giving an average economic output per person. Purchasing power parity GDP. Adjust for cost of living differences between countries, useful for international comparisons. Why GDP matters to you and me. When GDP grows, it usually means the economy is expanding, companies are producing more, jobs are being created, and incomes tend to rise. In a shrinking GDP environment, what we might call a recession, the opposite is often true. Layoffs increase, consumer spending drops, and credit becomes harder to get. GDP isn't just a number for policymakers, it ripples into everyday life. It influences job security. In a strong economy, you're more likely to find and keep work. It affects investment returns. Corporate profits generally grow alongside GDP. And it shapes borrowing costs. Central banks often raise interest rates during strong growth to prevent overheating. The limits of GDP. Of course, GDP isn't perfect. It doesn't account for income inequality. It ignores environmental damage. And it overlooks unpaid work, like caregiving, that still adds value to society. So, while it's a key metric, it's not the only thing we should look at. How inflation and GDP interact. Inflation and GDP are linked, but the relationship can be tricky. Demand pull inflation. This happens when GDP growth is strong, demand is high, and prices start rising because supply can't keep up. Cost push inflation. Prices rise even when GDP growth is weak, often due to supply shocks like oil shortages. Stagflation, the nightmare scenario. High inflation and stagnant or falling GDP at the same time. Central banks watch both closely. If GDP is growing too fast and inflation is rising, they might raise interest rates to cool things down. If GDP is falling and inflation is low, they might cut rates to stimulate spending. Practical strategies for navigating economic changes. Here's where it gets actionable. You can protect yourself and even profit by monitoring key indicators. Keep an eye on quarterly GDP reports and monthly inflation data. Adjusting asset allocation. Tilt toward inflation-resistant assets in high inflation periods. Shift to defensive stocks and stable income when growth slows. Refinancing debt strategically. Lock in low rates during slower economic periods before central banks raise them again. Maintaining an emergency fund. This gives you breathing room without forcing you to sell investments in a downturn. Leveraging the right tools and resources. Understanding these macroeconomic forces is one thing. Acting on them effectively is another. You need the right tools. If you want to trade smarter, you need a world-class, user-friendly trading platform that gives you real-time market data, advanced charting tools, and seamless execution. This isn't just for day traders, it's for anyone serious about protecting and growing their wealth. Check out the platform I recommend, crystalballmarkets.com trading platform. And if you're newer to this, or you want to brush up on your macro and market fundamentals, you'll love the beginner-friendly trading, investing, macroeconomics, and financial markets podcast from Crystal Ball Markets. They break down complex topics in plain language. All right, let's wrap this up. Inflation and GDP may sound like big-picture concepts, but they're constantly shaping the financial landscape you operate in. Inflation quietly erodes savings, and GDP reflects whether the economy is expanding or contracting. By keeping an eye on both, adjusting your financial strategy accordingly, and using the right tools, you can not only protect your wealth, but position yourself to seize opportunities as they arise. Thanks for joining me today on Financial Market Insights for Traders. If you found value in this episode, subscribe, share it with a friend, and don't forget to check out the resources I mentioned. Until next time, I'm Sophia, and I'll see you in the next episode.